Welcome back to, welcome back to the continuation of the board meeting. We're a little behind schedule, but we were efficient before lunch, so we're not too bad. So we're on to tab 3, investment policy decisions. And John, I think that's all yours.
I'll take these.
Or Dan. How did you get out of that?
I forced it on the executive.
You won the arm wrestling contest.
I see.
Two separately managed accounts for you, Mr. Chairman, board members. The first is Governor's Office has leaned on us to deploy about $89 million in ARPA funds through a loan program, whether that's down payment assistance or some of the others. That money will start coming back, and despite it being zero interest and long amortizations, we do have some individuals who are looking to pay off early. So we need a place to deposit that money. This SMA would be the repayment account that would receive the repayment of any ARPA loans made by the DOI. We would use it, I mentioned earlier, sort of the internal security purchases where we were buying higher yielding loans that were still below market to prop up some of our other funds. In this case, we would buy the lowest yielding assets into that pool. So you'll see that any approved loan under the state of Montana would be eligible as an investment. So where we have things like the IRP that are 2%, we would purchase them into this pool, get them out of Coal Trust, maximize the returns on Coal Trust.
Good. And all that was within the legal.
Yep.
What's the ultimate purpose for those funds once repaid?
There is none. Just park it in an account.
Okay. As long as it's not in cap or trust fund.
So it will be outside of those. Our goal would be to purchase low yielding trust fund loans and park them into this account.
Makes sense.
That makes sense to you too, John?
Yes.
Okay. So since we've got two of them, right under the cover page is the first one, State Treasurer's Fund Investment Policy. You're just allowing this in there, is that what you're doing?
So as I mentioned to the chair, he asked several years ago when we first approved this if we were being too conservative with, if you look on page 2 of 3 under section F, securities and TFIP purchases are permitted only up to an amount equal to 50% of the lowest 12-month average account balance over the past 10 years. We've been monitoring that. The Treasurer's Fund balance has been growing over that amount of time. We think we have more flexibility to manage that lowest threshold. And as I like to point out to the budget director, it was during my tenure as budget director because he had more money than I could ever dream of having when I had that job. But it's currently $660 million would be the maximum that we would be allowed to purchase into trust fund for the Treasurer's Fund. We don't think we'll go that far, but you were right, Mr. Chairman. It was a bit conservative. We want to get this in as soon as we can to capitalize on rates before they come down.
Why do they have such a big balance in the Treasurer's Fund?
There's a lot of cash out there. There's ARPA funds. You had the big spike in income tax collections as people moved into state since COVID. You've got the property tax collections up. So there's a big balance. And then some of the outflows didn't go as was expected. So the income tax rebates did not go out as robustly as they thought they would. So only about 100 million of the projected 250 in income tax rebates were actually spent. So just a lot of people didn't claim them.
Sure. Can I get their names?
Yeah. What are you selling?
Property tax rebates?
The property tax rebates, they did not go out like they would have thought. So there'll be a healthy balance in that for a number of years, moving to the full 10-year minimum.
So roughly
Seems to make
600
sense.
and some thousand
600 some million, yep.
million is gonna move into TFIP.
Yep.
We're already like close to half of that is already in trust fund.
Okay.
So it just gives us more capacity.
Good. Any questions or comments?
That's good.
If not, is there a motion to approve policy number 0.943.
So moved.
Okay,
I'll second it.
moved and seconded. Any discussion? If not, all in favor, say aye.
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 Opposed? Go ahead, Maggie, before you.
That's right.
All right. Any opposed? Hearing none, approved unanimously. Maggie, did you have something?
Do we have to approve this other policy?
Yeah, it's
Okay,
the
sorry.
next page. I don't know, it's been backwards in my book and I couldn't change.
It's all right.
Is that all right?
Can I make a motion
You may.
to approve policy number 40954, repayment account investment policy statement?
Very good. Is there a second?
Second.
Moved and seconded. Again, Dan explained all that. Is there any questions? If not, all those in favor say aye.
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 Any opposed, same sign. Hearing none, that's approved unanimously. Anything else in that tab, Dan?
Nothing else in that tab?
Okay, so we're done with tab 3. We'll go to tab 4, the most exciting part, the CEM study. Do you want to introduce our guest?
You bet. There's Franco Wang. He's our partner at CEM. He does the report for us. Franco, we'll just have you walk through as opposed to screen share. And high level, good report. We'll let Franco go, and then John and I are available for any questions. So Franco, thank you.
Sure. Thanks much, Dan. Good morning, Mr. Chairperson. Good morning, members of the board. Good morning. Good afternoon. Sorry, time zones. My name is Franco Wong. It's my job today to give an overview of the performance and the cost of the Montana Board of Investments. We'll be comparing you to the broad CEM universe, but as well, we'll be comparing you on the cost side to a peer group that's more banded around you in size. So I'll pause just for 15 seconds on the starting page to do 2 housekeeping items. One, we are looking at results as of calendar year end 2023. So to the extent that you've seen more recent reporting, quarterly reporting since then, or there's been changes made in the program, those won't be reflected in the results we're looking at in this report. That's item 1. The other item is, I just want to take a moment to extend a thank you to the management team. It's non-trivial work to get the data into CEM, and then there's lots of follow-up afterwards just to make sure that it's fit for purpose, it's comparable to what we're getting from everyone else. And so roundabout way of saying, we wouldn't be able to do this without you. And so we did want to take a moment to extend a thank you for the partnership. Moving on to page 2 of the executive summary. I'm not going to read this out to you because we'll unpack each of these as we go through the rest of the deck. But at a high level, you've had good results for this 5-year period. You've delivered returns that are well above that of the US universe. That's ultimately what you get, back in pocket to reinvest. And so from both a actual return perspective as well as I'll call it policy return, but for you, it's a little bit different. I'll explain more when we get there. So for both from an actual and a policy return perspective, you're doing well relative to the US public universe. From an implementation impact perspective, which you can kind of think of as the incremental impact that management has had on those targets, on that policy weights, that's also been positive. It's 0.9% on this, but that's rounding. It's effectively 86 basis points. And then from a cost perspective, you are paying more than what your benchmark cost is, but you're delivering 5-year implementation impact that's an order of magnitude greater than that cost that's higher than the benchmark. There's one primary driver of your higher than benchmark cost status. We'll unpack it when we get there, but the short of it is that you're making decisions to be more active in certain spaces. And so it ties back to the performance side because investment performance, to add more value, to have more active management, you have to pay to play. And so your cost structure reflects that, but you've received value commensurate and above the incremental cost. On page 3, we show a trend of the universe as it's grown over time. And I pull this up just to note that when we're comparing your performance, so your net returns and your net value added, we'll be comparing you to the US public universe. And that's the broadest universe that we have, that's most comparable to you, similar, similar regulatory environment, similar constraints on investment opportunities, and ultimately, similar liabilities that are denoted in US dollars. And so from that perspective, for performance, we want to compare you to as broad a peer group as we can. The same doesn't make sense to do so on cost, because size impacts costs. And so on page 4, we show an anonymized view, but a view of the 16 US sponsors that are banded around you in size. And so you'll see Montana highlighted in the lighter blue in the middle. Ultimately, what we're trying to do with the peer group is to select a peer set that gets similar access to opportunities to internalize, that gets similar access to sit where you sit on tiered fee schedules and so on. Because when we look at investment management cost, size matters. And so we compare you to this peer group that's more narrow but more similar to you in AUM. On page 5, we do the first comparison. And so this is that net total return comparison. Ultimately, this is for the total fund. Effectively, again, what you get back in pocket to reinvest, to pay your liabilities, to build the program, and so on. And so 5-year net total return of 9.4%, well above both the US public median of 8.9% and the peer median of 8.6%. I'll probably, as we go through this, we refer to both the universe and the peers in the reporting, but really the relevant comparator group here is the US public universe. And so the only comment I'll make on this is that, it's been fairly consistent outperformance for you over the past 5 years relative to the US universe. On page 6, we look at your policy return. And I alluded to this a bit earlier, but what we're collecting for Montana as your policy return is a little bit different than what we're collecting from the peer participants. For a lot of peer participants, they have a set strategic asset allocation or top of the house policy for where they invest, and the bands on that they're allowed on where they invest. For Montana, we're collecting just the mid-range of your targets of your investment allocations. And so there's going to be a little bit of a delta between what we have for you and what we have for the peers. And part of that, what we'll show on the next page as well, is driving this performance differential. So your policy return is also a very good story. You've had you've had a higher policy return relative to the peers, and that's primarily driven by a higher allocation to U.S. equities. I'll mention it on this slide, but one of the pieces of work that we've done is standardizing self-reported private equity benchmarks. And so the context on that is when we look at self-reported private equity benchmarks for the entire universe, for all the participants, we see a really wide range in what people report. And a bit of the issue is that they tend to run the gamut of what is a reasonable benchmark, something that's equity-based that you expect to look like private equity portfolios, versus long-term targets like, hey, my hurdle rate's 8%, so I'm going to put 8%. Or it's a cash plus a premium benchmark, which isn't investable. And the short of it is there's a whole slew of issues that can add more noise than signal in value-added comparisons. And so what we've done is we've thrown out self-reported benchmarks and leveled the playing field, so to speak. So we're giving everyone a lagged small cap equity benchmark, which really just gets the benchmark to agree with the actual portfolio on when major market events happens. By doing that, we get a better view on net value added and implementation impacts, and how your implementation impact compares to the same for the peers in the universe. So we do a bit of a reconciliation of why your policy return is different than the US public universe's policy return. It's just a wall of numbers on the right. So if you allow me to direct your attention, I think the two most relevant pieces, and sorry for those in the room, we're on page 7. You have a lot more US equity, a lot more US stock compared to the US public average. So that's that first row on the table on the right. You have 30% compared to the US public of 18%. And it has been for the 5-year period ending 2023, very good 5-year period for performance for US equities. And so that's a huge chunk of what's driving your overall, I'll call the relative strength of your policy portfolio. The other piece is you've avoided hedge funds. You don't have hedge funds over this 5-year period, and hedge funds have been one of the worst performing asset classes over this period as well. Page 8 looks at that implementation impact and quantifies it. I'll just note on this page that your implementation impact, 0.9%, that 86 basis points, is below the US public median. It's below the peer median as well. But if you'll remember on the policy piece, you do have a more difficult benchmark. You have a higher policy return. And so ultimately, it's still a good news story in that you have a higher actual net return, which is what you have back in pocket, and you're still outperforming a hurdle that's higher than the hurdle for the U.S. public peers. Any questions on performance before I move into the cost and asset mix comparisons?
Do you want to take a bow on no hedge funds, or do you want to just do
No,
that?
it's a given. But just in a high level, it seems to me this is a very good report on performance, one that we can be proud of. Do you see any cracks or anything that from a board level we should be looking at, or what is your opinion looking at it as an outsider, how we're doing?
Yeah, so CEM, just for context, CEM doesn't, I'm not allowed to provide an opinion. We're a data and insights company only, and so it's just we can kind of point out potholes in the road, but we can't tell you not to step on them.
Right? What are our potholes?
Where's some there's nothing ostensibly that I see. Like when I look at your asset mix, this is stuff that's deeper than just what's in the executive summary. But one of the pieces that we see is long-term U.S. equity markets look to be fairly efficient. And so that's a piece of research that we can share with our clients saying like, hey, active management can work in the U.S. equity space, but you have to be really confident that you have an edge and that it's a repeatable, demonstrable, and consistent edge. And if you're not confident in that, you should just go passive. And you're fully passive in U.S. equities, and so that's in line with long-term market research that we've done. The hedge funds is a big piece. Like one of the papers that we did, it's been 7 or 8 years now, but that we did almost a decade ago, looked at hedge fund performance and specifically hedge fund performance in major market turmoil. And what we found is that even all these uncorrelated strategies and absolute return strategies, whenever there's a major market event, correlations all spike up, and hedge funds didn't deliver. At least when we looked at it in the global financial crisis, they didn't hedge as much as their name would suggest. So yeah, that's very much in line. The only item that I'd point out as a difference is that you are more concentrated in U.S. equities. Referring back to page 7, it's not as stark of a difference as this page would suggest, because you have 30%, the U.S. public has 18%, but the universe also has some allocated to global equities. I think 7 or 8% last I looked at it. And global equities is 70% U.S. equity. So really, you're only about 6 or 7% more allocated to U.S. equity compared to the peers. But That is a difference that we see for Montana relative to the universe.
Okay, thank you.
Just ask a simple question. You use a policy return. What does that mean? How do you define that?
So it's for the peers, it is effectively what they could have gotten if they just invested fully passively. So there's a couple of different approaches. Some plans use like a reference portfolio that just has, hey, my long-term target is 5.5%. That's what I need to be able to fulfill my pension promise. I'm going to come up with an equity and bond blend that meets that 5.5% over long term. Some organizations just leave it there and say, hey, this is our policy benchmark, and management, it's your job to go and beat this policy benchmark. Other organizations take it a step further and say, hey, we have this 60-40 mix of global equities and global bonds, but we think we can do a little bit better than that. We can build a better beta and get better access to different markets. Like if we split up the 60% in equities, and say, hey, we want 25% in U.S. equity, 15% in EFI, 20% in emerging. That's high, but I'm making the numbers up. But effectively, they say that, hey, we can come up with a better diversified or better returning portfolio than that, and then that becomes the policy portfolio. And then it's the same thing. They hand that to management and say, hey, can you go and deviate from the policy, make active decisions, don't go passive in certain places and give money to active managers, and then effectively just try to beat that benchmark. So the policy portfolio is effectively that baseline of what do we need to deliver, what do we need to deliver on.
What did you use in this report for our performance?
So John will keep me honest on this, but we use the midpoint of, you have target bands for each of your asset classes. We use the midpoints of all of those and then weighted it up so that it gets to 100%.
And it's for our, correct me if I'm wrong, Franco, but it's for our benchmarks that we've chosen here.
It's the ones that you guys.
Somebody else may have chosen something very different, as Franco's kind of pointing out.
Yeah.
And that's where we kind of, it's not, I guess it's not real apples to apples in my mind, right? I would argue that we have chosen appropriate, but sometimes more difficult benchmarks than some of our peers.
Yeah, and I
see the differential.
That kind of goes, yeah. I see that.
Yeah, that's fair. And I'll just note that for the policy return in itself, like we don't, so I corrected myself earlier, we don't ascribe, good or bad to a higher or lower policy return. Everyone's dealing with like different demographics, different AUM, different, contribution rates and so on. And so because all the liabilities are all different, the policy return that you come up with for your plan, exactly as you mentioned, John, is not the same apples to everyone else. We have the building blocks so we can explain where it's different, but that's not to say, for policy return, higher is better, lower is worse. The implementation impact is probably a better view on that, which is to say, hey, you have your set policy. Now, are you doing better or worse than that policy? Okay, so going to page 9, we take a first look at asset mix differences relative to the peers. And we look at this, excuse me, we look at this to provide some context on the next few slides, which is the cost comparisons. Excuse me, I'm sorry, I drank too much fizzy water and it's, all right. It's fizzy. Okay, so right, we use this to provide context on the reasons why your cost profile is different than peers, and it's just acknowledging the fact that the starkest example, private equity costs more than public equity, and within public equity there's cost differences. So for you, high cost assets for you are in line with the peers, and high cost assets are those private market investments. They include hedge funds for the peers, but real estate, private infrastructure, private equity, and so on. So your allocation to high cost assets is in line with peers. Where your mix is markedly different, and I've alluded to this a couple times, is within public equity. You have about 27% allocated to U.S. equity, and that is higher than the peer group. That's higher than the peer group and the U.S. public universe. And so on page 10, when we then compare your total investment cost, that's why you're below the median cost in the peer group. So just a quick, I know we've seen these box and whisker charts a few times now, but this is the biggest one we've seen so far. A quick primer on reading it. The box contains 50% of data. The line in the middle is the median, and then the upper whisker and the lower whisker are 75th percentile to 90th percentile and 25th percentile down to 10th percentile, respectively. And so on this distribution, you're close to the bottom quartile in terms of cost, but by and large, that's due to asset mix differences versus the peer group. And so because this is only just a raw comparison of why your costs are different, we want to focus on a benchmark cost comparison. And so flipping to page 11, that is that benchmark cost comparison. And really what this is if we were to take, your physical asset mix, everything that you're invested in, the US equity, private equity, and so on, and say, if we handed this to the peer group and you implemented it the way the peer group implements and you paid what the peers pay, what would your cost structure be? What would it then cost you? And so the results of it are saying that your peer group would effectively be about 5 basis points, 4.8 basis points lower cost than what you've run the program for. Actually, the second one I'll get to in the next slide, but the reason why I alluded to earlier is because you're more actively managed, and in private markets, you're deploying more capital. And when you deploy more capital in newer vintage LPs, there is a cost associated with it. You're earlier on the J curve. You have to pay on commitments before they've gone out and bought portfolio companies and so on. And so, there's a cost associated with effectively, accessing the highest degree of active management, which is, going out, buying a portfolio company, turning it around, doing all that stuff, and then selling it for profit. The point I wanted to make on this page is that you're about 10% different than your benchmark. And when we look at the universe, that's not an outlier. So the bottom left, the third paragraph on the left side, the universe is roughly 1/3, 1/3, 1/3 distributed. And we're on page 11, by the way. Is roughly 1/3, 1/3 distributed. And 1/3 is less than 10% different than the benchmark, another percent different than the benchmark. And so it's the group that's more than 20% different than the benchmark that we would go and say, hey, there's something very different about your cost structure relative to the benchmark cost. That might be fine, but it should be at least something that management and the board are aware of. You're not an outlier. You're roughly 10% different than the benchmark, and by and large, you're right at the upper end of the first group, lower end of the second group. Page 12 is a very high-level summary of the reasons why you're different than your benchmark. So it reconciles that 10% differential, the 4.8 basis points, and it's really a combination of being implemented in a lower cost implementation style, however, paying more than peers do for similar assets. And so on the former, it ends up being about $1.6 million of savings, 1.2 basis points. It's really a combination. This is just really a combination of, how active or passive are you? How internal or external are you? When you're out investing in private markets, do you use fund of funds? Do you use direct funds? Do you use co-investments? And each of these decisions has a cost associated with it. It costs more to be active than it does to be passive. It costs more to be in a fund of fund because you're paying 2 layers of fees than it does to be in a direct fund where you only pay 1 layer of fees. And it costs even less to be in co-investments where you're just effectively putting money up alongside the GP. And a lot of those arrangements tend to have no fee and no carry. So on the implementation style side, again, that's 1.6 million of savings, 1.2 basis points relative to the peers. Where that excess shows up is you pay more than peers for external investment management costs. So that's adding about $9.2 million, 6.7 basis points. The total of all of those pieces is, it's about 8.3, but six basis points. But you put those together, and that's what gets you the $6.7 million to 4.8 basis points of higher cost relative to the peer group. And for the external investment management costs, I'll just note that again, most of these are your newer private market investments. When you invest in a new GP, you're usually paying 2 and 20, or even if you negotiate them down, at least 170, 180 basis points. And that's really because, again, they're the most active form of investment. And at the beginning of the partnership, they probably haven't deployed your money yet. They just, have your commitments, they're charging you fees on the commitments, but they're out looking for good investment opportunities. And so when we look at that, that appears to be one of the drivers of why your cost is different than the peer group. Page 13, we can move past. Actually, it effectively just shows more visually that first half, reason 1, lower cost implementation style from page 12. So, you'll note the table on the left is the same table as reason 1. So I'll move past that. But yeah, to summarize, good 5-year results. You've delivered very good net returns. You've delivered an implementation impact that is positive and above your policy return. And you've delivered at a slight excess cost, but an excess cost that's an order of magnitude smaller than your implementation impact.
Good. Any questions? Dan?
So just quickly for the board, we do this report every other year, right before the legislative session. We track it in real time. I'm going to turn it over to John here in a second just to walk through some of the steps we've taken over the last 5 years that will continue to show up in the data as we move forward, like the move to passive, like the creation of the co-invest, things of that nature. I do present this to the PERS and TRS boards as well. And to me, that key takeaway slide, I just cut and paste this and show it as is. We're beating our peers. We're lower cost than our peers, and our asset allocation, the way I phrase it is, we're very good capitalists at the Board of Investments. If you are exceeding your benchmark and doing well, you're probably going to have the ability to charge a little bit more for your services, and we're able to capitalize on that. So that 4.8 basis points in benchmark costs more than pays for itself because we're getting better managers and a better asset. But John will walk through sort of what we've done and how we use this as part of a CQI process.
So if we had an incentive compensation, we'd have lower benchmarks, wouldn't we? In all likelihood.
I would recommend it, yes.
I mean, when you look at us compared to others in reaching the benchmark, the ones that are getting compensated based on that are gonna try to push those benchmarks.
They're gonna want them as low as
And that's
possible.
one of the things.
And that's, as you heard Franco say, our benchmarks tend to be a little higher than some of our peers because we have no incentive to game them. Our benchmark in the pension plan is 7.3%. We can create all of the filigree we want within the real assets portfolio or the real estate portfolio or the fixed income portfolio. High level has to roll up to 7.3.
And in fairness to our peers, they may have very different liabilities and things as we do. We don't always know, but I do believe that's not a non-factor when you
Well,
start
human
when you
nature.
start to talk about those things. Exactly. If you provide the incentive, they will figure
Well,
out.
because who else
ways
can
to
set it other than people doing it? I can't come in and set a benchmark for you.
Right.
If I did, it'd be crazy.
In effect, the board does set the benchmark, though.
Well, we do it with RVK, I mean, with advice, is what you do.
Yep. So John,
Okay, so, you know, things that you know that we've been focused on controlling our fees for many years. You know, we are, I think, better than we used to be about having a lot of upfront discussions with our managers about fees and making sure that they're fair and that we are aligned with our managers. So, you know, it's a focus right from jump. But other things we've kind of done over the last few years, so we went passive in domestic equity, as was noted about 3 years ago. During that process, we actually negotiated slightly lower fees, even though we were getting at that time with our passive investment managers. Since that period, we've reviewed all our public market manager contracts, negotiated for lower fees in many instances, particularly high yield, and some of our international managers, which I know Jason's talked with you about previously. We've got MFN clauses in all of our contracts to ensure that if similar peers, we have the same manager and a similar sized account as us were to get a fee break, that manager would need to come to us and also give us that fee break. So a little bit of protection. And that doesn't happen very often, but it has happened occasionally when they will come and just give us a lower fee because they're giving others that. We moved to lower cost ETFs across both domestic and international equities as well in the public markets. Within real assets, we moved to, we negotiated with our MLP manager earlier this year, ended up cutting our fee by almost half there. MLP manager is kind of the oil and gas pipeline manager that we have, that we've had for a while. Real estate, as you know, pursuing the separate accounts, we think is definitely a long-term fee savings device, so we're not paying the transaction fees of buying and selling in and out of a fund. You know, we find good properties, we put them in that separate account, we own it forever. We're not paying lawyers to you know, redo all the due diligence and all the other things that go into buying and selling a piece of property. In the private investment space, as you know, we just launched our co-investment program with Fisher Lynch. So that's no fee, no carry on investments with our managers that come into that account. So that over time, as we grow that, and it will take us several years to do it, but that will, you know, sort of buy down the overall fees that we pay within particularly the private equity space. And then within fixed income, you know, looking at hopefully going forward, reducing or eliminating our administrative costs as we hopefully get to the end of the reserving process here.
So you're saying this will work in the pipeline and be more comparable as far as cost side of things. However, your peers might be doing the same thing.
So our peers are doing the same things for sure. I would argue, so co-investments as an example, we're probably behind the curve there. So that's something that we definitely see as a catch-up, and that's one of the places I think Franco noted in this report where we're probably higher cost. Now, that isn't going to happen in a year, because it'll probably take us 5 years to get that co-investment program to the size that we ultimately think it should be. But nonetheless, we've started, and you know, we'll see that buy down as the years go by. And not all of our peers can do it, right? It is kind of a size thing there as well. I would say we're at a good spot where we can do a co-investment program. Obviously, we've decided to hire a manager to assist us in that process. There were a handful of other pension plans at the NASIO meeting that were doing a similar thing, that had just either hired a manager or were bringing it in-house in one way, shape, or form. But then there's other plans that are just probably too small to really make it work. So it will be adapted over time for sure.
Any questions for Dan or John? Anything else for Ian? If not, thank you for your report. We appreciate the work you do for us, and we'll see you in a couple of years, and maybe you'll be able to give some commentary.
Yeah, yeah, absolutely. We'll see how it changes. All right. Thank you all. Thanks for the
Franco.
partnership. Take care. Bye-bye.
Franco.
So next thing is separate accounts review. Do you want a little break, or do you want to just move right in?
Let's just keep going.
All right.
Ramasco's already here.
And he's awake, so this is good.
Yeah, we're making progress as a people.
Yeah. So, John, I guess I get to turn it all over to you.
Great, and I'll turn it over to Kirsten.
Oh, all right.
Oh, you're getting that management down.
Awesome. Well, good afternoon, Chairman, members of the board. I'm Kirsten Haswell. I'm an investment officer on our fixed income team. You got to hear from us just last time, so that's always great. You already know we're responsible for managing the core internal fixed income portfolios. So today we're going to talk about our work with what we call our separately managed accounts. Guess I'm jumping ahead here. Turn to page 3. Here's a list of our assets under management in our separate accounts. These are state agency accounts that can invest in more than just STIP. We have 72 total separate accounts. We categorize them into 4 different classifications. There's the permanent trust funds. As the name would suggest, these are funds that we expect to be permanent in nature. We have the expendable trust funds, meaning the funds are meant to be spent down at some point. An example of that would be a Beltwater treatment plant. We have our insurance funds like state fund and group benefits. And finally, we have the operating accounts like those for the universities, Treasurer's Fund, and FWP's license account.
What's the blue highlighting on some of them?
So the last time we did this, the blue accounts were new accounts that we had recently opened since the last time we had done this. We haven't opened any since then, but kept them blue for you so you know, constantly moving, right? Moving on to slide 4 here. Since we went through these slides and then the next few in the last meeting, we'll probably go through them relatively quickly so we can spend the bulk of our time talking about specific separate accounts so you get an idea of how we manage them. But of course, questions are always welcome. Everyone on the fixed income team has both primary and backup responsibilities on a number of our separately managed account. As you can imagine, with 72 accounts, we all have to do some of the work for all of them. And these accounts are not model portfolios where you can just set it and forget it. We work with our clients to understand the accounts, the cash flows they have, the expectations of how and where the funds will be spent, as well as who the other stakeholders may be. This is because the clients are the experts in their field of work, so we need some input to make sure we're doing a good job in these investments. These, of course, are ongoing relationships since timing of cash flows can change, market expectations can change, and so, you know, constant monitoring and communication is beneficial. Moving on to slide 5 here. You know, there are a number of accounts that are STIP only, but these separate accounts all have their own investment policy statements. Usually the policies allow for some combination of STIP and trust fund. Occasionally, we'll also have individual securities. This makes the most sense if we have known outflows and we're trying to match the cash flow to that known outflow. And if there are any questions of what I've talked about so far, happy to answer. If not, I'll hand it over to Willie to talk about trust fund.
Mr. Chair, members of the board, my name is Willie Gross. I'm an investment analyst with the fixed income team. And like Kirsten said, I'll be talking about trust fund. And as Kirsten mentioned, separate accounts are able to invest in a combination of trust fund, STIP, and in certain scenarios, independent or individual securities. And so I'll be talking through trust fund and Sam will go through STIP. As you know, trust fund is one of our long-term investment portfolios. As you can see here on slide 6, the strategic objective has to do with creating an opportunity for the separate accounts to invest in a diversified pool of assets that creates returns that support respective client missions. As with any investment, trust fund does have some inherent risks. We mitigate those risks through the investment objectives. And those investment objectives are centered around making sure that we're taking prudent amount of risks and also preserving principal through diversification. Moving on to slide 7, we'll take a look at cash distributions of trust fund. And so what we're looking at here is a graph showing the orange line is showing the index yield, and the blue line is showing the 12-month moving average of cash distributions from trust fund. And you'll see that on the right-hand side of the curve, we're looking at approximately $8 million worth of monthly cash distributions, which over the entire fiscal year 2024 was equivalent to $118 million of cash distributions out of trust fund. These cash distributions are, from the client's perspective, one of the most important parts of their investment. And so if we just look at this graph going back in time a little bit, you'll see on the far left-hand side of the graph, we'll go back to 2013 and all the way through approximately August of 2021. Those yields were very low at about 2 to 3 and even 1% in the years immediately preceding COVID, or the years immediately after COVID. And so those persistently low interest rates exhibited downward pressure on the trust fund cash distributions. But since then, in the past few years, we've seen interest rates pop back up, as we all know, and that's represented by the jump you see in the orange line on the right-hand side of the graph. And you can see a similar increase in trust fund distributions. The final note for this slide is the inclusion of real estate and real assets in trust fund has not only helped stabilize returns, but also helps protect against any adverse movements in interest rates. So that's all I have for trust fund right now. Just a quick review since we've talked about it a few months ago, but if no questions, we'll move on to STIP with Sam.
Good afternoon. My name is Sam Holman. I am an analyst on the fixed income team. And as Willie mentioned, I'll be going over STIP. Maybe just to start, a little background. As we all know, STIP is pretty short and as such yields less than the trust fund. The current balance in STIP is about $8.5 billion. And then as far as participant composition in STIP, all state agencies are required to use STIP as their cash investment, whereas local governments across the state have the option to invest in STIP. It's about an 80-20 split as in terms of dollars invested between state and local governments. STIP has 3 objectives that we focus on. First, in order of importance, is preservation of principal. We do this by investing in safe and short securities, primarily treasuries, ABCP, CDs, agencies, and money market funds. Second is liquidity. STIP is the source of cash for most of the state's obligations. We have to make sure we have enough cash every day to match outflows, both expected and unexpected. Some of these outflows include pension payments, payroll, hospital payments, and so forth. And then the last objective we focus on is return. Historically, we have performed in line with similar money market funds and pools. Distributable income is an important source of funds, similar to trust fund, because it can be used in operating budgets across the state. And as such, we attempt to minimize costs and maximize distributions. In fiscal year 24, STIP distributions to participants were approximately $447 million, which when you break out the state portion of that was one of the largest sources of revenue in the state. Moving on to the next slide, slide 9. Here in the chart down at the bottom, we can see the yield and performance trends in STIP over the last 15 years or so. STIP yields were pretty steady over the last year and a half, 2 years. The average yield has been about 5.35 over the last year. They peaked at 5.45% about a year ago, and due to the Fed cutting rates last month, we're down to about 5.17% now. We expect the yield to continue to decline as the Federal Reserve continues their rate cutting cycle. Happy to take any questions. Overall, I would just say that we understand the importance of STIP to all our participants and in satisfying liability payments across the state. Kirsten does an excellent job as the primary portfolio manager, but we as a team all have the opportunity to trade in the portfolio, which we all enjoy doing and see as a great opportunity that we believe adds value. So with that, I'll hand things back over to Kirsten.
Great. Our largest separate account after Treasurer's Fund is the Montana State Fund Insurance Account. It also happens to be slightly more complex due to the inclusion of equity in the asset allocation. Montana State Fund provides Montana employers with an option for workers' compensation insurance and guarantees coverage for all employers in Montana. We want to attain investment returns that assist State Fund in meeting liabilities and assist them in being able to maintain stable, cost-effective rates for the employers of Montana. Workers' compensation benefit payments generally require immediate medical payments and then up to decades of ongoing medical and indemnity payments. Because of this, the portfolio needs to be invested in a way that supports payments and operations without taking on undue risk so that we can continue supporting their business needs and by extension, the employers and employees of Montana. We'll move on to the next slide. 11 here. As you can see in the asset allocation on this page, the vast majority of the funds are invested in core fixed income. We manage the state fund core fixed income internally, similar to trust fund or the core pension portfolio. I will say we do expect this core fixed income allocation to decrease slightly based on the inclusion of private credit and a larger allocation to real assets. Are there any questions about state fund? Excellent. Well, then I will hand this over to our team leader, John, to give a brief recap, and then we get to start on the more fun portion of this presentation, where we'll talk about some of our separately managed accounts.
Thanks, Kirsten. Mr. Chairman, I'm John Ramosko, your Director of Fixed Income. Just to recap, as Kirsten mentioned, all of the team members have primary and backup responsibilities for separate accounts. And we find it really interesting working with the different accounts and wanted to maybe give you guys a little bit of flavor about what some of those accounts are and what they do. So I'm going to start with the Coal Tax Permanent Fund. So looking at the chart on this page, you can see it's pretty self-explanatory. Not much going on here. Only 17 possibilities for the funds, but because I like to listen to myself talk, maybe I'll go into this a little bit. First of all, think of the chart as a left-hand side and right-hand side. The left-hand side is the constitutional side, if you will, and the right-hand side is the legislature's current appropriation side, mostly. So on the left-hand side, we can see the permanent funds. So of the $77 million, 38 odd million went into the permanent side, and over time has been divvied up into 6 permanent accounts. So what are those permanent accounts? Well, starting with number 2 there, that's the Montana Coal Endowment. And earnings from that fund go to the Department of Commerce, and they provide grants to local governments for infrastructure projects. Looking at number 3, that's the Regional Water Fund, and that goes to the Department of Natural Resources for drinking water projects in north central and eastern Montana. And so that's an interesting one to me, because the region that goes to is essentially from Havre west to Cut Bank and above Dutton to the Canadian border. So another way of thinking about that is that's the Marias River Tiber Reservoir area that those funds support. Going on to number 4, that's the Big Sky Economic Development Fund. And that money goes to the Department of Commerce, and they provide grants for economically valuable projects to local governments and to certified regional development corporations. Going on, number 7 there is the Conservation District Fund. That's a new fund. You can tell by the balance. It's starting to get 65% of total receipts, but it's new, so it's only got about 19 million in it, and those earnings will go to the DNRC to do conservation districts. I skipped the School Facilities Fund, sorry about that. That was a new fund 2 sessions ago, but it also got $100 million inflow from the general fund at the last session. So that's why it's newer, but has a little north of 200 million in it. And the funds from that go to the legislature to distribute to school facilities. So that's the permanent side, or the constitutional side. On the right-hand side, you can see the current spending, except you'll note 2 of those funds have the word trust in them. And so they're not constitutional trusts, they're the legislature's own determination that this is going to be a permanent fund. And so those are the State Parks Fund. So earnings from that go to Fish, Wildlife, and Parks, and they use that money to buy and maintain campgrounds, state parks, historical monuments, that sort of thing. And finally, number 16 there is the Cultural Trust, and that money goes to the Montana Arts Council, primarily for preserving works of art at the state capitol, but in addition to other cultural and aesthetic projects. So any questions on how we divvy that up?
Can you email that to us?
Yes, if it's okay, I will email you the link to where it exists in the governor's budget office. Sorry, this is in the legislative fiscal division. Yep.
Wherever it links to is fine.
But it won't be any clearer. It's blurry in that presentation as well. Sorry about that.
I can't get up quite close.
Is there any funds that are particularly hard to manage or real easy, or are they all roughly the same?
Well, they're very similar, Jack, in that there are generally a high amount of trust fund investment pool and a small amount of STIP. The permanent fund is a little bit funny because money flows in and out of the trust fund investment pool to the loans that Doug manages. And so that's a wrinkle that we always have to keep in mind. And some of the newer funds, the inflow is much higher than the current balance, as you would expect. And so that's always a wrinkle that we have to manage. And so speaking of inflows, on the next slide, I wanted to show you historically what inflows, total receipts for poll tax have been for the past 5 fiscal years. And a couple of things to note is that it's lumpy. It's lumpy can be lumpy both inside a year and among the years. And so you can see that the amounts have come up significantly from their lows at the beginning of the decade. The governor's office projects that funds will be close, going forward, will be close to what we saw in 2024, down just a little bit. And so that's important for us to note because we expect that we will invest those funds, but we are not exactly sure of the timing of when those funds will show up.
So the 24, 23 years, is that primarily because short-term rates went up?
So these are, I meant to show here, Mark, that these are the tax receipts.
Okay.
And so,
Investment.
yeah.
These are the tax rates. Oh, the coal severance.
Yeah.
Wow.
They're really
It's like
very
the tax that, yeah, it's the price of production.
So a lot of factors at play there, but they're up from in the past several years and expected to, by the governor's office, to stabilize slightly lower than what we're seeing right now.
Is that, just a quick question, is that the severance tax itself, is that constitutional or is that statutory?
It is, I'm going to say constitutional, and I'm going to look over at my executive
The
director.
rate is statutory, the flow is constitutional. So this is a statutory rate
Right.
that they set X% per ton.
Uh-huh.
And then these dollars flow based on the constitutional 50% left-hand side, 50% right-hand side.
Right, that makes sense, but the actual tax rate itself is legislative.
Right.
Going on to the next slide, I wanted to show you a history of distributions in just the coal tax permanent fund. That was number 5 on the complex chart. I wanted to show that for a couple of reasons. One is because it's the biggest of the sub funds, and secondarily, it hasn't had new inflows in the time period that we show here. So this is a little bit better demonstration of what the actual effect of interest rates have been over time on distributions to one of our participants. And so some things that we can observe are that we see the general overall decline in yields in the market that we saw throughout most of the decade. But we can see in more recent years that the fluctuations have been muted. And that's, well, a couple of things. One is because there is a lag, but the biggest reason is because back in 2018, the board dramatically increased the allocation to real estate, and then subsequently to real assets. And so as we've put significant investments into those asset classes, that has tamped down some of that fluctuation. And so that's why we saw the yield for the overall market fall 2/3 between 2018 and 2021, but only, maybe 20% in that same time period for distributions in the fund. And then you can see on the right-hand side in recent years that those distributions have gone up, and we expect to capture some of that upside as yields went up.
So I told John I wouldn't make him do this, but the more I see this chart, I feel like we have to. And that is the impact of the legislatively mandated loan portfolios and its impact on this.
Right, so the denominator of this has changed a little bit. Not because of new money in, but because money can go in and out based on the level of activity in the loan funds with the things that Doug's managed. And so we can see that it's gone from in the mid 2010, 2011, 2012, about 75% of the fund was in trust fund investment pool. Now, and this has been stable for the past 3 or almost 4 years now. Now it's about 2/3 trust fund, 1/3 loans. So that does have an impact. And this is just the distributions from the trust fund. This doesn't show the distributions, the earnings from the loans that Doug manages. So happy to take any questions, more questions, and if not,
They're low returning.
Right, I mean, so back in 2005, it was, what Cindy and I remember is TSEP and the Renewable Resource Grants and Loans. And basically everything else was going into the permanent fund. And then as time went forward, 2005, we created the Big Sky Economic Development Trust. So you can see that big drop off in 2006. So now you had the 75, 25, well, 25, 25, 50, or 25, 25, 25, 25, I think it was, of 25 to TSEP, 25 to Renewable Resource, 25 to the new Big Sky Trust, and 25 to Permanent Fund. Then you fast forward and you can see where in that late 2015-16 range, we created the Big Sky, or the school facilities account. And you can see another drop off. But at the same time, you were seeing, you start to see the veteran home loan program that's yielding about 1%. You've got the IRP program that's yielding 2%. You've got the multifamily coal home loan program in 19 that's yielding about 2.2%. So the legislature, as they keep creating these loan programs with subsidized rates, you can see the yield, they're eating their own lunch. So my fear is that at some point someone sees this chart and says, why isn't the board producing? So we're constantly vigilant on, you can't, it's a policy decision of the legislature if you want to do 1% loans with the coal trust. But that's a policy decision and not an investment decision. Therefore, you got to look in the mirror instead of pointing at us.
How come, well, that's probably, we'll talk about that another time.
Okay.
The legislature, I mean, why, things have changed, I guess.
Yeah.
They can't touch the principal, but they can strip the earnings.
Exactly, and that's what they're doing, is if you can't get a general fund appropriation to fund your $50 million project, you go get 50 million of the coal trust to do your project, and the fiscal note will only show an assumed rate loss. So the earnings is far less than the initial appropriation. So like for instance, on the coal loan program, they said, you're able to do the fiscal note that says, oh, we think we're gonna get 4% on these loans, and it's gonna, trickle out the door fairly slowly, so the fiscal impact's less. Well, then 2 years later, you go back and look what actually happened. Well, it was a lot of money out the door real quick at 1%. Well, this is general fund revenue.
It's the same thing with tax credits. You reduce the revenue coming in, it's not a budget item.
It's not an appropriation.
And that's the flaw in the system.
Show them.
Sorry, John, I know I said no, but I just see the chart and I get mad.
Well, you said you didn't want me to talk about it. We know that's true.
I'm not wrong, I'm just right in a different way.
Thank you. With that, I will turn it over to Sam Holman.
All right, so I'm going to talk a little bit about the Belt Water Treatment Plant. This account is one that we have with the Department of Environmental Quality. It was created to fund the operating and maintenance costs for the cleanup of Belt Creek. Currently, Belt Creek is being contaminated with acid mine drainage flowing out of the Anaconda Belt Mine, which gives it this orange color. Moving on to the next slide, maybe just to give a little bit of history. So the Anaconda Belt Mine was a coal and coke mine operating from 1877 to 1924. It was a source of coal for various operations in Great Falls and the Anaconda Copper Company's mining operations in Butte, Anaconda, and Great Falls. At its peak, it employed 1,200 people and generated 3,000 tons of coal per day. And then on the map on this slide, we can kind of see where the mine tunnels are located, which is the southwestern edge of Belt. And then the source of the issue is water flowing through the mine over the leftover pyrite nodules, which creates sulfuric acid and iron hydroxide, which is what gives it that orange color that we saw on that first slide. And then there's also different types of metal in the water as well, making it not suitable for recreation or agriculture.
Or fish or trees.
Yeah. Yep. Moving on to the next slide. Instead of y'all listening to me talk, I thought I would share a video that DEQ put together a few years ago to kind of go over the project and its purpose. So bear with me while I try to share this.
So this is not a permanent trust fund or permanent fund type of thing?
Well, I don't know what the definition of permanent is, but it's an 80 to 100 year life that, so maybe.
And that's the hope, Mark, but if costs come in higher down the road, it could be expended in totality in a shorter period of time.
Hi, my name is Bill Snowdy. I'm the program manager for the Montana Abandoned Mine Lands program. Today I'm in Belt, Montana, and we're looking at acid mine drainage from the historic Anaconda coal mine that provided coke and coal to the smelter in Great Falls, Montana. We're tasked with reclaiming abandoned coal mines, mines that ceased operation before 1977 and have no responsible party today. The water you see behind me is acid mine drainage coming out of that mine. The Abandoned Mine Lands program, part of the DEQ, is going to build a water treatment plant here in Belt to clean this water and help restore Belt Creek. The water treatment plant is under construction now. We just started doing the civil engineering work, building pads and ponds for use once the structure is completed. That will be our work this year. On this Belt Water Treatment Plant, we're privileged to have a lot of partners. Cascade County is deeply involved. They want to see Belt Creek restored. The city of Belt is obviously very interested in getting this done and helping us any way they can. The Department of Natural Resources and Conservation here in Montana provided generous grant funding to help pay for the construction. This is going to be a multi-partnered project before it's finished. The Abandoned Mine Lands program is important because of what it can do for individuals and communities and the state of Montana. In Belt, we're going to treat about 160 gallons of water a minute, make it clean, and change the water quality in Belt Creek back to pre-mining conditions or as close to it as we can. And next spring, roll into building the plant itself. We're looking forward to that being ultimately completed in about 2023.
Maybe just to highlight some other details that weren't mentioned in the video. So the plant is expected to operate for 80 to 100 years. Construction costs are expected to be between $7 and $9 million. Most of that, the construction costs will come out of the abandoned mine lands account. But then the $500,000 a year over the expected life will come out of this Belt Water Treatment Plant account. To treat the water, the plant will add lime, which neutralizes the acidity and raises the pH. This process will also remove the majority of the metals that are in the water. And then also one thing I would note, that video said it was supposed to be done in 2023. I think originally it was supposed to be done several years ago, but these things tend to take longer than planned, and now they're expecting a completion date of spring of 2025.
How much is in that account?
There's about 25 billion in it right now. Kind of to go off that, there's currently 22.6 million in trust fund and 3 million in STIP for a total of 25.6 in the account. As for managing the account, we will remain in communication with DEQ, our client, to make sure we manage the account in a way that suits their goals and needs. They have provided a schedule that outlines their expected O&M costs and other contingency costs, and based on which we think the account is currently positioned well to support the plant's operations for its expected life, but have the ability to adjust as needed and as we continue to communicate with our client. Any questions? Great. Just wanted to say thank you for the opportunity to work on these accounts. They're pretty fun and interesting to work on the different things across the state that have a real impact, and it's great to be a part of. With that, I'll hand things over to Willie to talk about the University of Montana.
Thank you, Sam.
Is that where you went to school?
It is not, no.
But you're gonna talk about it.
Yeah, so this is an account that we manage for the University of Montana operating account. And so we have monthly communication with them and their accounting team to talk through future plans and what the account looks like at the current moment. And so actually right now we're in the process of setting up 2 sub-accounts. One will support the annual powwow that they host, and the other will help out with the Lubrecht Experimental Forest, which is about 30 miles northeast of Missoula. And so just an example of kind of working with their accounting team and seeing exactly what they need. Since this is an operating account, we have the majority in STIP. So you can see in that pie chart there, 73% is in STIP, 27% is in trust fund. And that's just to help with liquidity as they need, certain money coming in and out for their day-to-day operations. And on the next slide, we'll actually get a dollar breakdown of the account. So that 27% is equivalent to $29.4 million, and that's in trust fund, and the remaining $79.1 million is in STIP. And going back to the distributions that we had referenced earlier, for fiscal year 2024, U of M received $1.1 million in distributions from their operating account that they keep with us. And just to kind of frame that within how the university might think about it or might use it, that's equivalent to 66 full scholarships for this current year, or using fiscal year 2024's information, 9 full chemistry professors. So like Sam said before, just another example of a way that we can really concretely see some positive impact we're having around the state. Thank you. Hand it over to Kirsten.
So I'm going to talk about our Fish, Wildlife, and Parks general license account. So this is not just your boat, RV, four-wheeler, licenses. You have to get registration, but camping fees, all the hunting and fishing licenses. And so you can see this account growth over the last 10 years. This isn't just from, higher rates and earning more on their investments, but also, more licenses issued and a higher cost for some of them. This is good though for FWP because they get to use the investment income for operations and maintenance So we'll go ahead and look at the next slide here. You can see the asset allocation is very similar to the University of Montana, also being an operating account. They have large and varied inflows and outflows depending on the time of year and things. So a large allocation to STIP makes sense to fund all those cash flows. And then in the chart on the right, you can see, how much the number of licenses have increased over the last couple of years. I do like to point out that, if you're an avid outdoorsman like I am, you know that a lot of combination licenses are no longer issued. So, instead of having a conservation fishing license, you have to buy your conservation license, a fishing license, and an invasive aquatic species license, so to go fishing. So, this maybe not as big of a change as it looks like in the charts here. I guess kind of thinking, why does this matter? What is this operations and maintenance that FWP pays for with the investment earnings? Conservation. Future generations can enjoy Montana's beauty and wildlife. Infrastructure to maintain the parks and recreations, which helps support tourism in the state. Wildlife management, so again, future generations can game and fish in our state. Public outreach, this is kind of an education, right? Foster a sense of stewardship among both residents and visitors. And finally, the economic benefit, healthy environment with sustainable management, conservation directly translates to long-term economic growth for the state. So, are there any questions on FWP?
Well, us older people don't have to pay as much for those conservation
Yeah,
licenses
that's nice.
because we can't walk as far.
Right? Yeah, right. Well, and I was told not to tell you, but you don't need one if you're using the bathroom. So you got caught without it, just say you're using the restroom in the park.
Oh my
Sorry.
God. Wow. Good to know.
Really?
Hot tip,
Draft
yes.
out of the-
Right, if they have a bathroom, I guess is the question there. But anyways, so. Hey, you didn't even turn on the light. Anyways, in summary, we've shown you some case samples of how the board is directly responsible for funds to support a number of very important and interesting priorities of the state. We're not just focused on retirement funds, right? We're also supporting education, infrastructure, clean water, recreation, long-term economic benefits to the state. So thank you for letting us share in your responsibility for that and placing your trust in our team to make a difference in the state.
Thank you.
Great.
In the past, some of these accounts, we've invited them to lunch. And one of the things I always like talking to them is how appreciative they were for our work. And I think that's still absolutely true.
Well, one of the things we'll be doing is a participant lunch. We've done it the last few years. Typically, the pensions show up, maybe U of M, sometimes the treasurer's office, but I'm pretty sure it's 100% dependent on the menu as opposed to the content of the conversation.
Perhaps the location too. I mean, if you did it somewhere downtown as opposed to the conference room, maybe.
I mean, maybe, but
And a group up.
costs. We gotta watch costs.
Of course.
Okay, well, thank you all.
Thanks.
And I'm a little disappointed nobody picked on John.
Meeting's not over, but I will be here.
So do you want a break now, Dan, or do you?
Yep.
Okay, and then we'll finish up with asset allocation. Welcome back, we're in the home stretch. Next thing, an important one, is asset allocation. I guess, John, you're in charge.
All right, Mr. Chairman, I'm on tab 6. Thought we would go through sort of the process here first and foremost. You've seen all these slides for the most part last year, but we'll cover it again for refresh everybody's memory. Please stop me at any point if you've got questions. So moving to slide 2 here, asset allocation, it's a critical part of what the board does. It's the most significant driver of returns over the long term. You see that from the macro attribution that Aaron shows you every quarter when we do the performance reviews. Points out the diversification of the portfolio, protects us against extreme outcomes, and that process that we go through highlights the benefits of diversification in the portfolios. There is no right answer in asset allocation. It's just a process that we go through. We're blending together a number of factors and considerations to try to come up with the best answer that we can. The actual results that we get from this process are certainly not going to play out as the model predicts. We're really just trying to understand the range of potential outcomes and select the best option based on our objectives from that.
So I just note that this decision, the board reserves this to itself. So this is in our governance, that this is a critical thing.
Turning to slide 3, just a little bit about the specific process here. So, as we kind of start this, usually we're in the middle of the year or maybe a little earlier, looking at the client objectives and constraints, whether that's pension or trust fund or state fund, talking to whoever we need to determine if anything has changed. We're looking at the global economic environment. Each of our directors certainly has a particular view on that typically, given their investment focus and their varied experiences. We're looking at the capital market assumptions that are produced by RBK as well as other market participants. Once we've kind of digested all of that information, all the senior investment staff and the cabinet submit kind of their proposed asset allocation to me. I aggregate that info and generally look for areas where the team has collectively a strong view or views, create some scenarios around that for RBK to run for us. They run their process through the mean variance optimization model that they have. I've got some notes here on the MVO analysis. I mean, it is sort of the best thing we have, but there are a number of flaws with that model, or things at least that we need to be aware of as we go through the process. It's a long way of saying that the model is far from perfect. That's what we have to work with, and it's a good process to go through as long as we apply our own qualitative judgment to that process. We then, once we've gathered all of that info up, we have our offsite asset allocation meeting with RBK. We went to New York this year so that we could sort of do that process, and then as long as we were on that trip, we could go visit a lot of our managers and broker dealers and things as well, which I think worked out pretty well. Questions about any of that before I move on here? All right, seeing none, moving to slide 4. Net cash need, again, I've shown you this, I think, the last couple of years anyway. So, we always want to be cognizant of the liquidity that we have in the portfolio. Number one thing is we want to avoid being a forced seller in a down market. We know that we have cash needs within the pension portfolio in particular. And so this is focused here, these two tables, PERS and TRS, the two biggest pension plans. You can see over on the far right, to kind of summarize it all, that's the percentage of cash flow that we need from our assets that we need to pay out, because contributions don't cover the cost of those benefits. So we need to come up with, in the last few years, something just shy of 4% to pay out benefits. Just got the info from both of the plans for the 2024 timeframe. I'm happy that it came out about maybe 3.8%, so it actually went down just a little bit, but it's staying kind of in that range. It's kind of what we expected. I think it will stay, kind of around that 4% level for the next, call it 4 to 6 years, until we sort of roll over with the baby boomer retirements in effect. And then I think it probably starts to tail back down a little bit.
So it'd be a real concern if that was going up, especially
Yeah, if it
high.
keeps going up, if we got above kind of that 5% level, that's sort of the point at which you start to kind of think, okay, maybe I need to change my views on asset allocation. I need more liquidity here than I thought I needed. So happy to see that that's sort of leveling out, if you will.
The systems give you their expected contributions and benefits?
So that comes from the actuarial reports that they.
Okay, but do they give you a projection going forward too, so you can plan for, like, say,
They do have that within those reports.
Okay,
Yes.
so
There's a
you have a
projection.
chance to plan out a little bit farther than
Yes,
1 year.
you can sort of
You
see
know,
the wave coming, I guess. if
Jack,
you
I
will.
can only say that when these guys start retiring, that thing's gonna go up, you know?
Talked about that in the evals, and only 2/3 of us are allowed to retire at any one time.
John,
Yes.
why did you say you expect this to go down in the future?
You kind of do. So there's a pretty big retirement wave with the baby boomers, and then that retirement wave should tail off, just demographics
So you got fewer
essentially.
people retiring.
Yeah.
Okay.
Yes.
Well, and the add-on to that is, at least within the PERS system, the GABA, the Guaranteed Annual Benefit Adjustment, goes from 3% to 1.5%
That's
to
right.
variable. So the plan will get, the normal cost of the plan will get cheaper over the next 5 to 10 years.
And it's less significant, but that exists to some degree in teachers as well.
Yeah.
But then as wages have been going up, you've got more contribution.
Right.
So,
I mean, there's a lot of variables there, which is why I'm kind of looking at this every year and making sure that this is actually tracking, because you could have less hiring, then maybe wages didn't go up as much, maybe inflation's different than, there are lots of variables here that could change that. But, knock on wood, it looks within expectations at this point, and certainly manageable given what we are planning for at this point. Similarly, look at trust fund and state fund as well. Trust fund, it's pretty easy to distribute their income for the most part, so, we need to have at least that much liquidity, but that's fairly easy for us. State fund, pretty similar, their dividend payout has been essentially even with essentially their income over a longer period of time, so they do need liquidity, obviously, for their potential claims payouts and things like that. That's certainly something that we have to take into consideration as well from a liquidity standpoint. Turning to slide 5, just showing you here the history again. I won't go through all this in any great detail, but I think and have seen that broad strokes, public equities probably tick down just a little bit in terms of our overall allocation there over the last 5 years. A lot of that has gone into private investments, real estate and real assets. Probably the only really big move I would say that we made in asset allocation over this time frame is core fixed income, where we took it down pretty significantly in 2020 as we were, at 0% interest rates basically, and could see that rates were going to go up at some point or another, so we took that down quite a bit. And then non-core fixed income brought that up a little bit as well over the last few years. Trust fund and state fund on slide 6. Again, as you know, John talked about it a little bit earlier, the big increase to the real estate range in 2020. Added real assets here more recently. State fund somewhat similarly. We added non-core fixed income back in 2020, and then real assets as well more recently here. So a few changes there over the time frame, and I guess not to short sell it as well, and state fund moving to the full aggregate index, so increasing our duration within the fixed income space over time there was also a fairly big change to their portfolio.
you get a better feel for how much money's core sits there overall. Because there's a lot of that money that, even though it moves, there's a certain amount that sits there.
Absolutely. Yeah. There's certainly a big base there that doesn't tend to change too much. So with that, quick summary, as Jack pointed out, asset allocation is a critical task for the board. and specifically called out in our policy. It's something that we pay a lot of attention to. We do this process annually. I think I would agree that's probably much more often than most of our peers, but I think we'd like to go ahead and take a look at it every single year. It's an imperfect process, but I think it is a good exercise to think about each year. Liquidity, as I noted, is very important, and we're constantly evaluating and adjusting the overall asset allocation on a daily basis within the ranges. So that's kind of where we have been and how the process works. Questions about that before I move to the memo, the proposal for this year?
John, I know before we do some of those decision points, there's an RVK thing. How are you going to work that into your presentation, or are you?
I wasn't going to go into any great detail on the RVK, analysis or anything. I provided it for you for informational purposes. You can take a look at it. I will say that the ones that I put in the book are kind of the base case scenarios. Paige and team were very kind to they actually did, sort of multiple analysis for us. We did more scenarios than what you see here, and we condensed some of that for the purposes of kind of giving you the base case for the board. But I wasn't going to go into any great depth, but I'm happy to.
And could I just ask,
or RVK can answer questions.
Yeah, I just want to, we have the consultants, and I like that report you did earlier, Becky. That was great, but I don't want you to review this like Jim used to. But anyway, on a super high, super fast level, basically, I just want to make sure you agree kind of what we're doing, and anything else you or Paige would like to add.
Well, maybe I'll kick it off, and Paige, please feel free to add to this. But we really look forward to this opportunity every year to just take a fresh look at the various portfolios and opportunities to improve their return per unit of risk, to see if there's any asset classes that needed to be added to or refined in terms of allocation. So we do bring that. We're running the scenarios that your team has come up with. We also review the portfolios that the model creates. It creates 10 efficient portfolios for each fund that we model, to see if there's any lessons that we should learn about modifications that could be beneficial. So John had made the comment, not a lot of other systems do this every year. That is true. A lot of them have a 3-year policy. That's probably more common. But even clients that I work with, in addition to Montana, they have a 3-year cycle, but they like to update the analysis every year to see if there's anything kind of brewing in terms of ideas. So the last thing that I would just add to the modeling, other than giving Paige all the credit for running all the models, she does a great job, and she works with our team too, that you don't see each meeting, but that are behind the scenes on both the assumptions and some of the legwork here. But we also take a look at Monte Carlo analysis to look at, as John mentioned, if you just stop at some of these models and just assume the world is perfect, you get the chance of a large return being the same as a symmetrical negative return. We know that's not the real world. We know we get a lot more corrections than probabilities entail. So we do run some risk analysis just to test various portfolios and enhancements. So it's a good process. We do get a chance to review where John and your team are thinking. Changes need to be made, opine on that. We have a healthy debate and discussion in our offsite meeting. So it isn't the case where we're just only taking things in and running the model. We're, as you know, we're free to offer our opinions. So that's what I just offer as a few comments. Paige, do you have anything you wanted to add to that?
No, I would maybe just say, as John mentioned, that the changes to the proposed ranges are very much on the margin here. We're talking about 1% from one asset class to another. And I think that one of the benefits of the current structure you have in place by having the midpoint ranges instead of having a strict target that you need to stick at is that your staff is positioned and has the ability to react to market dislocations as they occur. Forward-looking assumptions this year. Domestic equity, we do see valuations being really high, so it makes sense to us to take a little risk off the table there. So overall, we support what John's put in front of you today.
Okay, thank you. John?
Okay. So turning to the memo here, Mr. Chairman, at your pleasure, I can go through all of these, or I can stop at CAP and we can discuss that one and then do the other two, or I can go through all of them and then we can discuss it. How would you like me to approach that?
Let's just do it individually, because I'd like to vote on individual changes, so.
Sounds good. So starting with CAP, obviously proposing to go down a percentage point in domestic equity, both the proposed midpoint and the range, and up a percentage point for private investments. The reasoning here is fairly simple. Valuations, as we've been talking about for quite some time, are fairly expensive in domestic equity. I think it makes sense to do that. The return assumptions correspondingly for domestic equity are certainly towards the low end of the range. In fact, they're below what our actuarial hurdle would be, which is probably somewhat unusual for an equity asset class. Remember that private investments encompasses private equity, but also private credit, which we have been adding to at the margins here as well. Private credit actually has a higher return assumption than domestic equity does. And private equity has the highest return assumption in the capital market assumptions. So directionally, I think it makes sense. I kind of alluded to this, I think, at the last meeting, but looking at kind of where the proposed midpoints of the range are for private investments, real estate, real assets, you add those up with the proposal here, that comes to 34%, so about a third of the portfolio. I think that's about as far as I would be comfortable going with the illiquid asset classes. Now, that doesn't mean that we won't be above the midpoints from time to time, because as you know, the denominator effect can be very real when public markets have a downturn. Automatically, we move up significantly sometimes in the range for the illiquid asset classes because they don't reprice as quickly. But at the high level, just taking that liquidity into consideration, I think I would not likely be coming back unless there were some dramatic change, I guess, in the markets or something unforeseen, and suggesting that we continue to move that up. And I say that because we have been moving up all of those asset classes over the last 5 years, and I think we're about there at this point in terms of what I would be comfortable with. I think that's kind of the meat of it. And it's not a commentary on, I know we've gone back and forth for a long time. We've been overweight domestic equity, right? It's not a commentary that somehow, we don't still believe in the U.S. economic system. It's the most dynamic economy in the world that promotes innovation and rewards that. However, I think valuation-wise, that's kind of priced in at the moment. That's reflected. So that's sort of where this is stemming from at the moment. Maybe I'll pause there for CAP.
Okay, so just in our process, we set up where we do a proposal here and then maybe vote on it the next meeting. But that was, at least in my mind, set up in case there was big changes or something controversial or some board member had some issues with any of that. So unless somebody on the board doesn't agree with that, I'd like to actually take the final vote. And so we're done with this.
Can I ask some questions?
How much time do we have to have? Certainly, Mark, you can.
Relative to CAP.
Okay.
So you want to add to the private investments, but when you say that, where are you going to add to within that? Because we have private credit being recommended for the other two asset classes, 0 to 4%. So what percentage is private credit within the private investment?
So it's about a quarter of the portfolio.
Okay.
Credit, and I think it will roughly, I mean, these are not, it's not easy to just say, oh, it's gonna be X percentage, because it's hard.
A quarter of the
We're
private
making-
investment
But we would see it over the long term, that private credit's gonna be 20-25% of this portfolio within private investments. Yes.
Okay. Okay. And so, is that where you would see an increase, is on the private credit side, or just all overall in the private?
Well, I mean, to be honest, we're
where the opportunities?
we're at 17% right now.
Uh-huh.
So, I mean,
Okay.
this move would actually be a reflection of where we're at.
Okay.
That's just kind of where we've gotten to. I mean, as you know, it's very hard to target a particular, spot in private investments or real estate, real assets, because we're making commitments and the managers are drawing that money down as they see opportunities.
Yeah.
So that does not, necessarily line up.
And you're not suggesting any change in the international equity, and according to RBK's report, they're seeing a return that's higher than our domestic side, but isn't there risk in the international equity arena? Increasing risk?
Well, there certainly is, but there's risk in the domestic equity portfolio too. International equity, I guess I'll just say, if you looked back at probably, I don't know how far back, but quite a ways, the last several years and maybe a lot more, international equity has, the forecast has been that returns would be higher, and it has not come true year after year after year after year. That said, I think you've heard Jason talk about pretty much every quarter for the last several quarters that the divergence in valuations between international equity and US equity is about as wide as it's ever been. So I don't have the confidence necessarily to say, well, let's go increase international equity a great deal, but I'm also not recommending that we reduce it.
I mean, the downside, one standard deviation, is about the same as the US equity.
Yeah.
But the upside's better than the US equity.
It is at the moment.
Okay, all right. I'm done.
Yeah, well.
I've got one quick question.
Go ahead,
I think.
Mark. Sure.
I'm just curious, you've got a range here.
Yeah.
How does your actual number vary? How much does it vary over the course of the year? And how close is it to either end as a general rule?
So currently, we've been running probably a couple percentage points underweight the midpoint in domestic equity.
Under the midpoint?
Under the midpoint.
Okay.
And we've been running a little, maybe a percentage point under on international equity. And we've been overweight the midpoints in real estate and private investments in particular.
So you aim at the midpoint and just kind of go a point or two above it, depending upon what's going on.
Yes, I would say that's fair. That's probably the guide, but I mean, I've intentionally been underweight some of the public equity because of valuations. On the private equity and real estate side, sometimes that is just moving because of the denominator effect. I'll take real estate as an example. Denominator effect has probably put us over a little bit, but there's also been an intentional bias recently. I've had a lot of discussions with Ethan and Ron about, we want to reduce real estate probably back towards the midpoint. And to do that, we'll probably take more out of the core real estate funds. But we don't think now is the time to do it. I mean, Ethan's talked about valuations there the last few quarters. We're seeing that kind of stabilize. We're seeing transactions pick back up. We think there's some embedded performance that'll come back to us over the next few quarters. But once we start to sort of see that swing in liquidity, reinsert itself back into the real estate market, we'll probably take advantage of that at some point. So we might be overweight real estate for a while, until we see that opportunity to sort of take some off the board at maybe a slightly better level. So it, you know, there's a little bit of tactical there, but at the same time, trying not to be, you know, too cute about it. The main way that we're moving asset allocation is we have to pay benefits every month. And so I need to take money from somewhere typically to fund that. So we're gonna look out in the environment and say, well, you know, what looks expensive? Where should I take money off the table in order to achieve that? And so it's kind of a natural process, I guess, if you will, to take an underweight or do that, you know, and it's usually not a big swing, I guess, is my point, which I think is part of your question.
Yeah, what I'm wondering is if you move the range, like for example, on the domestic equity, a point either way on each end, it's really gonna change your behavior all that much?
No.
Yeah, that's what I thought.
But it is, those ranges is a good control for the board.
Yeah, sorry.
Those ranges are good control for the
No, I
board.
understand the control aspect.
Because
but I was
if
just wondering
they
about
were
the-
out of the range, it would be a real concern.
Yeah, I was just wondering about the actual behavior, whether once you got to the ranges.
When we breach, policy requires us to report to you that we've breached and what the cure we're proposing on those. So in the 2020 timeframe, right when John was hired, he immediately went out of the range.
I did.
We were very close.
We got really close.
We prepped you all
We
that.
lost $2 billion right
Yeah.
after I started, yeah.
And we.
But we made it all back.
We made it all. You're just helping, John. Thank you. So if we get out of that range, we report to you, and a lot of the times, the cure is, we're gonna write it out. We're a perpetual fund.
Yeah.
Taking immediate action is not the correct step. The midpoints are new since 2019 because there were some control issues with prior staff, and we wanted to introduce that macro attribution report to the board so you knew what we were doing and Aaron could report to you, hey, we're a little high in real estate, here's why. We're a little underweight in, but we wanted the staff to be more responsive to the board based on, not a target, because we did have the conversation of whether or not some funds have targets. And we made the conscious decision to not go to a target, to be constantly rebalancing to that. Let's have the range and then explain to the board each quarter why we are up or down from that, but then give John and the team the flexibility. And that's, you know, if you look back historically, we've made some, I'd say, pretty significant moves, particularly in cash. We're down cash a lot, thank God. But, you know, now it's tweaks around the edges is the goal. I mean, if we bring a big move in this to you, something broke in the process along the way. This should be 1s, 2s, and 3s, and anything more than that, you will have seen it coming for a long time.
So, Mark, so by increasing private investments, taking off the domestic, so to speak, but you're also looking at removing some from the real estate, but actually you're decreasing liquidity in the portfolio.
A little bit, yes.
But not anything measurable to really warrant worry.
Right.
And we did the liquidity analysis probably 4 years ago with RBK. So we had a lot of room to run on that
I
side.
mean, there's different ways of looking at liquidity, right? So, I mean, we have tons of liquidity. Okay, I mean, so we still have tons of public market equity. That's liquid. Any day, anytime. I don't care if it's the depths of, you know, the COVID crisis in 2020 or not. However, I think about it differently in that, do I want to sell domestic equity or international equity in, you know, late March 2020? It's liquid and I could pay benefits with it. Absolutely not. You know, I want to have cash, I wanna have some treasuries, you know, how far can I, that's what I really think about in terms of liquidity. What can I sell today to pay benefits that will not have a negative long-term impact on the portfolio? Because if I'm selling equities at the bottom of the market in order to pay benefits, that's not great. I don't have an opportunity to make those losses back then. I've paid it out. So that's how that's how I think about liquidity.
Maybe it's not so much on the pension funds, but maybe with private credit and the other two funds, there might be a question there.
Well, then there again, it's sort of, there's layers to this, right? So it's liquidity within those portfolios. So private credit has actually been extremely helpful to us in the private investments portfolio, because even during the crisis timeframes, it's still spitting off that interest, those loan payments, right? And I'm probably still getting capital calls from my private equity managers over here. So it's been a great counterbalance, if you will, to sort of the big picture funding within that private investments portfolio, not having to necessarily, over the course of a year, take so much liquidity from other places in the portfolio. You get to be a little bit more self-funded within that private investments portfolio. And actually, recently I had both Ethan and Rob and Thomas and Ian run that for me within their portfolios. What has our liquidity looked like? And actually in private investments, it pretty much pays for itself. In other words, we're getting pay downs from, legacy private equity portfolios and private credit stuff. And that's pretty much funding most of our new commitments.
Okay. So anyway, is there a motion to approve the proposed asset allocation for CAP?
So
moved. Is there a second?
I'll second.
Okay.
You can second.
No, you can second.
I'm easy.
I don't want to get in the middle of that.
Give it to
We'll rely
Mark.
on
Give it to Mark.
Give it to Mark. So moved and seconded. Any other questions? If not, we'll take a vote. All those in favor of the proposed change, please say aye.
Aye.
Any opposed? Hearing none, that's approved unanimously.
Thank you, Mr. Chairman. So moving maybe to the trust fund portfolio then. Again, not a huge change here, but proposing that we add private credit to the portfolio and reduce correspondingly our allocation to non-core fixed income. Kind of during this whole process, I guess a couple of things. Private credit is one of the higher returning asset classes in terms of the projections right now. We've also been talking to, as you know, we have a long-standing history with some private credit managers within the pension portfolio, had not added that to trust fund at this point, but partly because they kind of have these revolving funds. We are now at a place with one of our managers where they're going to have an evergreen structure. In other words, we can just invest with them, leave our principal there. They will continually roll loans through that portfolio, and we will just give a cash flow. That's fairly attractive, a little easier. We don't have to keep going and underwriting these things over and over again, particularly with some of these managers. As you maybe remember, we do tend to lean towards private credit managers that are on the conservative side of the spectrum, I would say. They are doing senior secured loans. They're very good at what they do. Their losses are very, very low. They've been through cycles. We can see that they do a good job. So, downside protection, as within any fixed income strategy, is paramount in my opinion. But we can garner a nice return there. And at the same time, over the last, call it decade or so, we've seen a real big shift in the markets from sort of the high yield market that we've also invested in for a long time. And a lot of those assets have moved to the private credit market. In other words, people aren't issuing as a public company in the high yield market as much as they used to be to fund things. They've gone to the private credit markets. Part of that being a function that Again, as you know, a lot of companies are choosing to remain private for a much longer period of time than they ever did in the past. So the size of that private credit market has increased enormously. So there's opportunities there. And then maybe finally, it's floating rate debt as opposed to fixed rate debt. So it does offer, yet another kind of diversification component. When you look at high yield and private credit, they're very similar in terms of if you were to apply ratings to the private credit companies underlying, they would look very much like a high yield portfolio. Different companies obviously because they're still private, but you get that same rating mix. But you'd have they'd be floating rate loans typically, not fixed like they are in the public markets.
So how many managers are you currently working with in the private credit arena?
So we've got 4 that I can think of off the top of my head.
Okay.
3 of those would be kind of the senior secured, safer managers, for lack of a better word. They're not doing distressed and opportunistic type things, which we would not be looking at that for either trust fund or state fund. It would only be in the senior secured, safer type managers.
You do distressed in the caps?
You do in cap, yes. Yep.
So and which strategy going to be in these 2 funds? Is this TFI?
It would be the senior secured, steady Eddie kind of lending.
Okay.
All right. Any other questions? So again, we'll just do these individually, but is there a motion to approve the changes in trust fund?
So moved, Mr. Chairman, as presented.
Okay, is there a second? Second, Porter. Any questions? If not, we'll take a vote. All those in favor of the proposed change, say aye.
Aye.
Aye. Yeah, those opposed, same sign. Hearing none, that's approved unanimously. Do you have anything else to say on the final one?
State fund is very much the same thing, right? It's the exact same thing I just talked about with trust funds. I think that it provides a different look for them, a little more diversification, take advantage of the market opportunity that is there.
Is this at a request of the state fund, or are you just trying to get them some more additional?
So trying to get them some additional yield. I mean, we've certainly looked at over the last several years. This gets into the weeds a little bit, but there are CLO managers out there. So CLO managers would buy these private loans and package them up. I don't love the CLO space because you're removed from the actual loan and you're dependent on what those people decided to package up and then tranche out. But in effect, you're getting the same thing more directly, where you control the quality of those loans. You have managers that are controlling the credit process and the quality of the loans that they have underlying in their portfolios, and they control them, as opposed to a CLO, which is just packaging this stuff up. So point being is a lot of their peers, when we look at the peer surveys and things on an annual basis, would have CLOs and things like that in the portfolio. I think this is a better way to achieve, essentially you're looking for that floating rate component. There's a differentiator there and accessing the private credit market side. I think it's a better way to do it to something like this, but it gives them that same sort of exposure. So, yeah.
Anything else on state fund? If not, is there a motion to approve? Move, second?
Second.
Moved and seconded. Questions? If not, all those in favor say aye.
Aye.
Aye. Any opposed, same sign? Hearing none, that's approved unanimously. John, what else do we have to do on that?
That's everything, Mr. Chairman. Thank you.
Any other questions for John while we got him here? Seeing none, Dan, turn it over to you for a minute.
All right, November meeting, 20th, 21st. Brief update, we'll plan for the session, see if there's any bills, see if there's anything we want to do. Hopefully not.
Too late to do that.
Not really. And then a lot of the annual compliance, so 217, policy 217 compliance, LPAC reporting, quarterly reports. We'll have the annual report ready for you. We will not have the financial statements likely at that point. I forgot to mention this morning during the audit committee, we have sent the UIPA financial statements to the Department of Administration, should be getting the enterprise statements to them, if not today, tomorrow. So our reporting for the year will be done. If we're too far behind on some of those things, if, for instance, the auditors haven't released financials or something of that nature, maybe getting a hold of everybody to bump that meeting back a bit. But for now, that's likely our time frame.
Are you likely to have a 2-day meeting or?
No, we won't have the financial we won't have the audit complete from the auditors, so the financial statements won't be audited at that point. So we'll have a special meeting at some point. Question becomes 1-day meeting with the special meeting, or if we just bump it and do one-day meeting later in the year.
Okay. Is there a preference, or I guess we just gotta wait for events?
It's all outside of our hands.
Okay.
You're gonna change your reporting structure this year if you get approval to go to enterprise?
If we get approval to go to a fiduciary or enterprise fund, it'll be reflected in the November 15th budget. I don't know, like I said, I'm visiting with the legislative audit division next week to see if there's a path that they can get comfortable with. If they're comfortable, then I'll approach the budget office and see if we can't make something work. If not, we'll talk about it in November and see if there's legislation needed.
Okay, but it's not gonna be in the financial statements that we're gonna be reviewing.
No, this is for last fiscal year. It actually wouldn't be in any financial statements you'll review next year either. If a change takes place, it would be for fiscal year beginning July 1, 2025. So you wouldn't review it until December of 26 for the changes.
Okay.
Otherwise?
Any assignments for Dan we got? Becky and Paige, is there anything you'd like to report to us? We appreciate you being here.
Nothing from us. We appreciate the opportunity to join virtually, but look forward to the next meeting, and we'll just stay tuned about whether that's in the current November dates or sometime later in the year.
Okay, good. So with that, I think we've accomplished everything, so we'll call meeting adjourned. Thank you all.